All right, here is one almost nobody talks about. There is a way to back early-stage Australian companies, get a tax offset just for putting your money in, and if it goes well, pay zero tax on the returns. Sounds cracking, right? It is called an ESVCLP, and yeah, the name is a proper mouthful. It stands for Early Stage Venture Capital Limited Partnership. But before you get too excited, there is a very good reason your average investor has never heard of it, let alone used one. So today, no fluff. Let us go through the whole thing together. What it actually is, how much you really get back, the risks nobody puts in the brochure, and straight up, whether it is a smart move or a hard pass for someone in your shoes. So let us start with what this thing actually is. An ESVCLP is basically a venture capital fund with a special government blessing. You put your money into the fund, and the fund pools it with everyone else's and invests it into small, early-stage Australian companies. The kind of young, risky businesses that a normal managed fund would not touch with a barge pole. The government wants money flowing into those companies because that is where a lot of future jobs and innovation come from. So it dangles a couple of tax carrots to get people to take the risk. That is the whole deal in a nutshell. You back some risky young Aussie companies and the ATO says thanks with a tax break. So what do you actually get? Really, 3 things, and I want to go through them honestly, the good and the not so good. First up, the tax offset. When you put money into an ESVCLP, you generally get a tax offset worth up to 10% of what you contributed. Now, an offset is not a deduction. It is even better in a way, because it comes straight off the tax you owe, dollar for dollar. So put in a chunk of money, and a slice of it comes straight back off your tax bill. There is a cap on how much offset you can claim, and it is non-refundable, meaning you need to actually owe tax to use it. But for someone with a decent tax bill, it is a real saving. Next one, and this is the big one, the returns can be tax-free. If the fund does well and those little companies grow, the income and the capital gains that flow back to you are generally exempt from tax. Think about that for a second. Normally, if you make a big gain in your own name, you could be handing the ATOs up to 47% of it. Inside an ESVCLP, if it works out, that gain can come to you completely tax-free. That is a seriously attractive feature, and it is really the main event here. And now the third thing, and I have to be straight with you, because this is where a lot of the hype goes quiet. There is no safety net. Some countries have schemes where the government covers part of your losses. That is not this. There is zero capital protection. These are early-stage companies, and plenty of them fail. That is just the nature of startups. If the ones in your fund go under, your money goes with them. So this is genuinely high-risk stuff. Keep that front and center while we talk about the rest. And a quick side note, because people mix these up, there is a related scheme called the ESIC rules, where if you invest directly into a qualifying early-stage innovation company yourself, you can actually get a bigger tax offset, around 20% plus a capital gains exemption. The trade-off is that you are backing a single startup you picked yourself, which is even riskier than a fund. The ESVCLP is the fund version, where a professional manager spreads your money across a bunch of companies. Same high-risk world, just 2 different doors in. Let me put the benefits together so you can picture it. Say you invest into one of these funds, you get up to 10% of that back as a tax offset in the year you contribute, which softens the blow straight away. And then, if the fund performs over the years, the gains come back to you tax-free, which is where the real money is. So the appeal is a bit of tax back now, and potentially tax-free upside later. Sounds great on paper, but, and it is a big but, all of that only matters if the fund actually performs, and that is far from guaranteed with early-stage companies. To put a rough number on it, if you put money in and the fund eventually doubled it, that gain could come back to you without the ATO taking its usual cut. On a big gain, that tax saving alone can be worth more than the upfront offset. But again, that only happens if the fund actually delivers, and plenty of them do not. Now let us talk about the catches, because there are some big ones. First, your money is locked up for a long time. These funds typically run for around 10 years because that is how long it takes for startups to grow or fail. You cannot just pull your cash out when you feel like it. It is highly illiquid. And just so you know how this actually works, you cannot buy an ESVCLP on a normal share app. You go through a registered venture capital fund manager, and as I mentioned, a lot of them will ask you to prove you are a wholesale investor before they even let you through the door. Second, there is a gate on the door. A lot of these funds are only open to what is called a wholesale or sophisticated investor, meaning you usually need a fair bit of income or assets to even get in. Third, the fees. Venture capital funds are not cheap to run, and those fees eat into your returns every year. And fourth, the big one, the track record of early stage investing is brutal. Most startups do not make it. The whole model relies on one or two big winners carrying a pile of losers. So that shiny 10% offset and the promise of tax-free gains means nothing if the fund quietly goes nowhere for a decade. Never let a tax break talk you into an investment you would not otherwise touch. So who is this actually for? Here is my honest take, starting with who it might suit. First, high-income Australians who have already made the most of the obvious stuff, especially super, and are looking for another tax-effective option with money they can genuinely afford to lose. Second, sophisticated or wholesale investors who understand venture capital are comfortable locking money away for the best part of a decade, and like the idea of backing Aussie innovation. Third, people who want a small, high-risk slice of their portfolio chasing big tax-free upside, and who will not lose sleep if it goes to zero. If that is you, a modest allocation might make sense. Now, who should give it a wide berth? First, beginners and lower income earners. If your tax bill is small, the offset does less for you, and honestly, you should not be taking this level of risk with money you cannot afford to lose. Second, and I cannot stress this enough, anyone who has not yet made the most of super and the basics. Super gives you a genuine tax break without betting on startups. So max that first, every time. Remember, inside super your money is generally taxed at just 15% while it grows, and it can be tax-free once you are retired and you did not have to gamble on a single company to get it. That is a reliable tax break sitting right there for almost everyone. Third, anyone who might need that money within 10 years because you simply cannot get at it. And fourth, anyone who would be gutted watching an investment drop to nothing, because with early stage companies, that is a real possibility. So let us bring it all together. An ESVCLP is a real tax break. Up to 10% back as an offset now, and potentially tax-free returns down the track. But it is high risk, it locks your money away for around a decade, it carries fees, it is often only open to wealthier investors, and most early-stage bets do not pay off. For the vast majority of people watching this, the game plan is simple. Make the most of your super. Build a solid base of low-cost ETFs, and only then, if you are a high earner who understands the risk and has money to spare, take a careful look at something like this as a small, spicy extra. Not before. And if you do decide to go in, keep it to a small slice of your overall portfolio, the kind of money that going to zero would sting but would not derail your life. Venture capital is a garnish, not the main meal, and treating it that way is how sensible investors use it without getting burned. And because these rules are technical and change, please check the current details and get proper advice before you commit a cent. Righto, honest word to finish on. If a tax break ever tempts you into something you do not fully understand, that is your cue to slow down and do the boring stuff first. Give this a like. If it saved you from a shiny distraction, subscribe if you want more straight-up breakdowns like this. And go check you are actually making the most of your super, because for almost everyone, that is the better move. Catch you next time.